Welcome everyone to the Financial Literacy Seminar. Today, Alicia Lloro will present on insights from the 2020 Survey on Household Economics and Decision-Making. Alicia is a senior economist in the Division of Consumer and Community Affairs at the Federal Reserve Board. To the audience, please submit any questions you have through the Q&A, which we will monitor and relay to Alicia to answer. Alicia, the floor is yours.
Okay, thanks, Vitali. Just double checking, you can all see my screen? All right, wonderful. So thank you so much to all the organizers for inviting me to speak. But before starting, I'd first like to acknowledge the whole SHED team. So I'm presenting here today, but SHED really is a group effort. So thanks to you all. And as a board employee, I also need to get in my disclaimer that the analyses and conclusions in this presentation are those of the staff presenting and do not indicate concurrence by other members of the staff or the Board of Governors. Okay, so here's just a brief overview of what I'll be talking about today. So much of my presentation is covering findings from the 2020 Survey of Household Economics and Decision-Making, which we call SHED. The SHED survey contains many topics, but for this presentation, I'll be focusing on 4 broad areas listed here: overall well-being, employment, education and childcare, and family finances. I'll also talk briefly about a simple experiment we included in the 2020 SHED around the financial literacy questions. And also here, I want to note that I'm really not an expert at all in financial literacy. I'm new to the space. So please forgive any ignorance on my part as I make my way through that section. And then finally, I'll give a brief overview of the new topics and questions that we've added for the 2021 SHED. So the 2020 SHED was fielded back in November of 2020, and we had just over 11,000 respondents. So I just want to remind everybody that since the 2020 SHED was fielded in November, the results that I present here largely reflect what happened during the first 9 months or so of the pandemic. So one nice feature of the SHED too is that it has a panel component, which allows us to follow some of the same people over time. So in the 2020 SHED, we had nearly 4,000 people that also took the survey in 2019. So I'll be presenting some results that rely on the panel as well. For 2020, we also conducted 2 supplemental SHED surveys. The first was in April of 2020, and the second was in July of 2020. So I'll also include a few results from these supplements. And this really lets us see how things were evolving throughout the pandemic rather than just 2 snapshots between 2019 and 2020. And finally, as I just mentioned, I'll be presenting selected topics, but you can find the full report and the full data set with all of the topics on the Fed's SHED website, which the link is shown here, but you can get to it if you just Google Federal Reserve and then SHED. That should help you find it. Okay, so next we have our section on overall economic well-being. And here we highlight 3 main takeaways. The first is that there was a sharp increase in the share of people doing worse off financially than they were a year earlier. However, despite these setbacks, most people said that they were still doing at least okay financially. If we dig a little bit deeper into these results, we also observe growing disparities by race and ethnicity, and especially by education. And this appears to reflect the uneven hardships of the pandemic. For the past 7 years, we've asked people whether they think they are doing better off, worse off, or about the same financially as they were a year ago. So as you can see in the figure, the share saying they were doing worse off increased sharply from 14% in 2019 up to 24% in 2020. And this is actually the highest share who's reported being worse off than a year ago since we started asking this question in 2014. So despite this large increase in the share saying they were doing worse off, most people still said they were doing at least okay financially. So by the end of 2020, 3/4 of people said they were doing at least okay financially. And this was actually unchanged from 2019. If we look at the dashed bars, you can see that it did fluctuate a bit throughout the year. So after the onset of the pandemic, in April, well-being dipped down to 72%. It then peaked in July after the distribution of the CARES Act funding, before falling back down to the 3/4 that we saw in 2019. So there are a couple reasons why we think this measure has remained mostly stable, despite the sharp rise we saw in the share who are worse off. So I think the primary reason is that many people who were worse off than a year earlier were already struggling financially. So we see in our survey and in other data that many of those hit hardest by the pandemic already had limited financial resources to begin with. Conversely, the people who kept their jobs, and especially those who are able to work from home, they generally entered the year in a relatively strong financial position, and they saw further financial improvements in 2020. Another reason we may see this pattern is that although some people indicated they're doing worse off than before, overall, they still felt their financial picture was okay. So these people may be worse off, but they are still generally satisfied with their financial picture. So looking now by education, although about 3/4 of adults were doing okay financially, we saw growing disparities by education. In all years, financial well-being is highest for those with at least a bachelor's degree, that's shown in the dark blue line, and then declines down with education to those who had less than a high school degree, that's shown in yellow. One thing we saw as well is that the gap in well-being between those with at least a bachelor's degree and those with less than a high school degree, which was already large before the pandemic, increased sharply from 2019 to 2020. By the end of 2020, nearly 90% of adults with at least a bachelor's degree said they were doing at least okay financially, whereas only 45% of those with less than a high school degree said they were doing at least okay financially. So we continue to see differences in financial well-being when we look by race and ethnicity. As of late 2020, nearly 2/3 of Black and Hispanic adults were doing at least okay financially, compared with 80% of white adults and 84% of Asian adults. So while we didn't see large changes in these differences through the pandemic, we do note that over the last few years, we have seen a steady increase in financial well-being for white adults and a slight decline in financial well-being for Black and Hispanic adults. And then just one minor note, 2020 was the first year that we were able to provide as separate estimates for Asian households. So that's why you only see the one estimate for Asian rather than the time trend like you do with the other race and ethnicities. So another way that we think about financial well-being is how people are seeing economic conditions in their own communities. And here we see sharp declines across the board. In the bottom row, you can see that the share of adults rating their local economy as good or excellent fell 20 percentage points from 63%, that's shown on the yellow circle, in 2019 down to 43% in 2020. And looking across different race and ethnicities and geographic areas, we can see that these declines were widespread. So it's clear that this declining sentiment about local economies wasn't just an isolated thing. We see it across a bunch of different groups. Okay, so before turning to employment, I'd like to pause just for a second to see if we've had any questions so far.
None so far, Alicia.
Okay, great, thank you. Okay, so on the next few slides, we'll talk about how the pandemic has affected workers. So we know many people were laid off. And as I mentioned earlier, these layoffs were concentrated among those who were least prepared for a setback. As a result, some workers who were laid off either increased borrowing and or struggled to pay bills. Also, as we are all very aware, conducting this seminar via Zoom, the pandemic affected where people work. Many more people worked from home, and this was particularly the case among workers with a bachelor's degree. So we'll look at that here on the next slide. So before turning to the figure, I'd first like to point out that the overall share of workers who worked from home changed quite a bit over the course, or from 2019 to 2020. 29% of workers who worked for someone else did so entirely from home in November of 2020. This share was similar to July, but down from the 41% just after the pandemic started in April of 2020. In 2019, we asked a slightly different question, but we found that among those who worked for someone else, a much smaller 7% typically worked from home. So we see a difference of 7% in fall of 2019, up to about 30% in fall of 2020. So the figure here shows that the prevalence of working from home varied quite a bit by education. So the top bar in dark blue shows that 46% of those with at least a bachelor's degree worked entirely from home. And this compares with only 10% for those with a high school degree or less, which is shown on the bottom bar in dark blue. Turning now to layoffs by race and ethnicity, the 2020 shed, it reflects the large declines in employment seen after the onset of the pandemic. As shown in the first bullet, as of November 2020, 14% of all adults were laid off over the prior year. Just for comparison, in the 2019 survey, we saw that 3% of adults were laid off over the prior year. Turning to the figure, layoffs, it shows layoffs for prime age adults by education and by race and ethnicity. So if we look at the top set of dark blue bars, it shows a sharp difference in layoffs by education. So those with at least a bachelor's degree were much less likely to experience a layoff than those without. And on the bottom set of lighter blue bars, we see similar sharp differences when we look by race and ethnicity, with Black and Hispanic prime age adults much more likely to be laid off than white and Asian prime age adults. Okay. As I mentioned earlier, about a third of the people who responded to the November 2020 survey also took the shed a year earlier. So this slide, we're showing results based on this panel group who responded to both surveys. So we can actually track their financial trajectory before and after the pandemic. So as a high-level overview, we see stark differences in financial well-being by employment status. Those who kept their jobs, they generally started out better off in the first place, and they have fared well through the pandemic. Whereas those who were laid off, particularly those who were still not employed, saw substantial declines in financial well-being. So unpacking this a bit, if we look at the left side of the figure here, it shows well-being in 2019. One thing that stands out is that workers who were laid off in the past 12 months, so that those are shown in the yellow and gray circles, they had much smaller financial cushions to begin with. 65% and 62% said they were doing at least okay. And this compares with much higher shares shown in blue for those who were not laid off. So now if we look at how well-being changed for workers through the pandemic, so that's going from left to right on the figure, those who were laid off and had not returned to work, that's shown in yellow, saw a sharp decline in well-being. It fell from 65% said they were doing at least okay in 2019, down to 51% in 2020. Alternatively, workers who kept their jobs, that's shown in both shades of blue, they generally had improving finances through the pandemic, and we see that reflected in their financial well-being increasing from 2019 to 2020. Okay, I'd once again like to pause briefly to see if there were any questions about the employment section.
So just a reminder to the audience that you can submit Q&A. There are none so far, but I had one quick question. So the effect on the decrease in workers who say they're doing at least okay financially among those that are laid off and currently not working, do you have a sense for how that varies, whether that was different during the pandemic or whether that effect is similar in prior years?
That's a good question. I haven't looked at that specifically. It's a little bit harder to get at in prior years just because the number of people who were laid off is so much smaller that we start to run into like really thin sample sizes when we try to dig in. So even here so this is using the panel component, we have, much fewer households. So I'm not sure that we would be able to do that with the panel, but we might be able to look at the characteristics and see kind of to speak to that question. Just more broadly, like with other measures, we do see similar trends for laid off workers as in past years. It's just that there were so many of them this year that it had bigger impacts.
Great. And so we got a couple questions. So the first is, so you describe a picture where most households indicate that they're doing okay, but at the same time, they view their communities as not doing okay. So is that something that you have investigated with respect to views of self versus community? And I think relatedly, does it correspond to particular industries where unemployment might be higher and the effect of that on well-being?
Yeah, that's a really good question. It's a bit of a puzzle why we see that, because it really is widespread. So you might think like, well, certain industries were hit, so those areas you would expect to see bigger changes, but it's really widespread across almost all measures. We can only get so fine as far as geography in the shed, but if you look like rural versus urban, you see similar results. So I'm not sure if it's a perception thing. You're looking at your community and you see like stores are closing, local businesses are suffering, restaurants, are struggling. You hear a lot of anecdotes about what's going on. I'm not sure if that's what it's reflecting, but it's a really good question and something that, we would like to learn more about.
Great, thank you.
Oops. All right. So moving on to education and childcare. So the challenges facing parents during the pandemic, they have been well discussed in the media and as we have been progressing through the pandemic. It's also very personal to me, having a 3-year-old at home. And results from the shed also reflect these challenges, showing that most parents experience disruption to their child's education or care after the onset of the pandemic. Many reported less availability to work because of these disruptions, and this was particularly the case among Black, Hispanic, and low-income mothers. Finally, in light of the shift to online schooling for many during the first year of the pandemic, the 2020 shed asked both parents and college students about their perceptions of online learning. And these results show that both groups related online schooling less favorably than in person. All right, so turning now to childcare and schooling disruptions and how that affected people's employment. So we see that many parents' ability to work was disrupted. Overall, 22% of parents reported either not working or working less because of childcare or schooling disruptions. So that's shown on the figure on the bottom bar. We also see that childcare and K-12 schooling disruptions disproportionately affected women. Before the pandemic, we already knew that childcare responsibilities had already prevented many mothers from entering or fully participating in the labor force. And during the pandemic, we saw this problem exacerbated. Mothers were much more likely than fathers to forego employment for childcare related reasons. So if we look at the top bar of the figure, we see that a quarter of mothers were either working less or not working at all because of disruptions to childcare or in-person K-12 schooling. And this compares with 18% of fathers. So we also see that the disruptions varied by demographics, with Black, Hispanic, and low-income mothers particularly affected. The top 3 bars show differences by race and ethnicity, and about 33%, around a third for both Hispanic and Black mothers were not working or working less, compared with 19% of white mothers. And we see similar patterns when we look by income on the bottom 2 bars. Nearly a third of mothers with family income under $50,000 said they were not working or working less, compared with 19% of those with family income of $50,000 or more. Okay, turning now to perceptions of quality of online K-12 education. So we asked parents who said that their youngest child was attending classes at least partly online at the time of the survey in November 2020. We asked them their perceptions about the quality of this online schooling. And overall, these parents viewed online education much less favorably than in-person education. Only 22% of parents agreed their child was learning just as much online as with in-person classes. So that's shown in the top blue bar, while 59% disagreed, shown in the yellow bar. Similarly, the next pair of bars shows that only 29% of parents agreed that their child remained connected to their peers while taking online classes. Other measures of parents' perceptions were more positive. So 73% thought their child had access to their teachers, and 82% said their child had adequate access to technology. But even so, those aren't 100%. And we recognize that access to teachers and access to technology is still a barrier for quite a few people, or students, that is. So now if we turn to perceptions about online higher education, we see similar results for those to K-12. So if we look at the top set of bars, only 3 in 10 students who have taken a course online since March agreed that online learning was worth the cost. The next set of bars show that about 1/3 agreed they were learning as much in-person classes as they were, learning as much online as they were in-person classes. Other characteristics regarding access to teachers and technology had similar results to what we just saw for K through 12. Okay, so once again, I'll pause before I move on to the next section of family finances.
Great. Yeah, we got a couple questions. So the first is with regard to the childcare schooling disruptions. Do you see the same differences by race and ethnicity when controlling for education level?
Yeah, so you do. Of course, once you control for things, the differences do get smaller, but it's not just an education or income story. And you also see them if you look at, single-headed households, like if you're thinking single parents or single female parents. And one thing I will note, I didn't get into too much, but we really see the strongest results, or the most consistent results rather, for Black mothers. When we look at other measures. I should point you all to some of my colleagues' work. Mike Zabek has a paper that's looking at childcare basically childcare and mothers' ability to work, which I won't talk about anymore because I've probably already mischaracterized it. But I will say I send you to him for more information on that.
And do you know the occupations of the people with childcare and schooling disruptions?
So we have broad occupation categories in SHED. So we could look at that. It's unclear if they're currently not working, like if it would, like what occupation it would show. But we could see the occupations for, we had like about 2/3 experienced disruptions to childcare. So we could look at if there's certain occupations were more likely to experience disruptions than others. But it seems like the disruptions are more around the availability of childcare and the schooling rather than what occupation the parent was in. So I'm not sure that there would be too many clear patterns there. I think there's really more of a difference if you look between like urban areas versus rural areas, or, the political leanings of the region where you are in, the likelihood that the school was closed down. Also just the market for daycares, if they're a lot of areas had shortages of daycares before the pandemic. So losing any of, daycare shutting down or closing also had placed a higher burden.
And so to that point about differences kind of across regions, across other characteristics, have you looked at disruptions across types of schools? For example, private versus public, if you have information on that. So for example, were parents of children at public schools more or less disrupted? Or are there any regional differences as well that you found?
Yeah, so we did look at that. It's a little bit difficult because of the way we ask the questions. So we know if the parent has a child attending a public or a private school, but we don't know which child attends the public or private school. And just to save on time, we only ask the parent about the youngest child. So we're not entirely sure what type of school the child is in. So we do have a bit of a measurement error problem there. So I wouldn't be fully confident in those results, looking public versus private. And as far as like Geography, I'm sure we looked at that. I don't remember off the top of my head though, but the data is there, so we could follow up with that.
Sure. And one other question, can you control for whether the student was enrolled a semester or more pre-pandemic? I think specifically with respect to perceptions of quality of online, of higher education.
We can with the panel. So we could do that. I'm trying to remember, it's been a minute since I looked at the exact question for the online higher education. So, yeah, I mean, I guess there's some concern if it's their first year in online education, they don't have anything to compare it to. But yeah, I think we could follow up on that to get people who it's not their first year in school. And we may have done that in the question and I'm not remembering. But we could certainly do that with the panel.
Great, thank you. I think that's it for questions on this section for now.
Okay, thank you. Okay, so now the last section on SHED results that we'll look at here is results on family finances. So some of the differences across groups that I've already highlighted are also evident in family finances. So in particular, income declines were much more prevalent among those with less education, which is consistent with a pattern in layoffs that I've already discussed. On the other hand, spending declines were much more common among those with more education. So this is possibly because those with more education have had a greater disposable income, and they may have been able to cut back on discretionary purchases, or just thinking, you know, it's the pandemic, everybody's quarantining at home. So other than, you know, online purchases, people are out and about less, perhaps spending less of their disposable income. And then lastly, the third key takeaway was related to mortgage refinancing activity, where we saw that higher income homeowners with mortgages were much more likely to have refinanced in the past year than those with lower incomes. Okay, starting with the overall estimate shown in the first bullet, 16% of adults in November said that they were unable to pay all of their bills in full that month. So notably, in spite of the challenges of the past year, the share who were unable to pay all of their bills in full was unchanged from the fall of 2019. However, similar to previous results, we continue to see differential effects across groups. So as shown in the graph, laid-off workers in the top set of bars were more likely to have difficulties paying their bills relative to workers who did not lose jobs in the past year. That's shown on the bottom set of bars. Also, if we look at Black and Hispanic adults, they were much more likely to have difficulty paying bills, particularly if they had experienced the layoff. And one thing that was really striking to me when I looked at this figure is that Black and Hispanic adults who were not laid off had similar rates of difficulty paying bills than white people who were laid off. So to me, this figure really shows stark differences that we're seeing across race and ethnicity. Okay. Now we turn to credit card debt changes since last year. So when we look at these changes compared to a year ago, we see a similar pattern to what we have seen on some previous slides. So consistent with the finding that those who kept their jobs were generally faring well, here we also see they reduced credit card debt. Alternatively, those who were laid off were more likely to have increased debt compared to a year ago. So similar, Vitaly, to what you mentioned before, this is a relationship where it's consistent with what we've seen in the past for laid off workers. It's just that for 2020, a much larger share of people faced layoffs. If we look at adults overall, however, we do see a reduction in credit card debt. This is driven largely by people who kept their jobs. And this pattern is notably different from the results in previous years, where the shares of credit card holders having more or less debt were about even. Okay, looking now at retirement savings. Occasionally, retirement savings can serve as a source of emergency fund for non-retirees who face economic hardships. And provisions in the CARES Act allowed for more favorable tax treatment of COVID-related distributions from retirement accounts like IRAs and 401ks. Overall, we saw that 9% of non-retired adults cashed out or borrowed from their retirement savings in the prior 12 months. And this is only a slight uptick from the share who reported doing so in 2019. So one thing to note about this figure, that the results shown here are based on a general question asked about cashing out or borrowing from a retirement account. So they could also include taxable accounts and not just the tax preferred accounts covered by the CARES Act. So as shown in the figure, non-retired adults who experienced the layoff in the past year were more likely to have tapped retirement savings at 14%. In the report, we also note that people who were laid off were less likely to report having any self-directed retirement savings to begin with. So the concentration of employment losses among workers who are already less likely to have these types of accounts limited the number of laid off workers who could tap retirement savings in response to these policy changes. Okay, so next we're going to look at income and spending changes. So we'll look at income changes first. So when asked about how their total monthly income compared to the year before, 19% of adults overall said their income had declined since the prior year, while a larger 24% said their incomes had increased. Responses to this question differed by education, as shown in the figure. Adults with less than a high school degree, shown in the yellow bar, were more likely to have experienced a decline in their income relative to those with more education. So as discussed earlier, those with less education were more likely to have experienced layoffs in the past year. And so that may contribute to this pattern of income changes we're seeing here. Okay, turning now to spending. In contrast to the results on income, the figure on this slide shows those that with less education were less likely to have seen a decline in their spending. 17% of adults with less than a high school degree said their spending declined, that's shown in yellow, compared to 27% of adults with a bachelor's degree or more. So as noted in the last bullet, changes in spending are also related to employment disruptions, as just over 1/3 of adults who were laid off also spent less compared to a year earlier. Okay, and the 2020 shed also added a question on mortgage refinancing. And here we saw that decreases in interest rates prompted many to refinance their mortgages. As summarized in the first bullet, results from the November survey showed that 1/5 of homeowners with mortgages refinanced within the prior year. As shown in the figure on the right, refinancing varied by income. So among homeowners with mortgages, high income borrowers were much more likely to refinance, most notably those with incomes of 100,000 or more. That's shown at the bottom bar. Also not shown, refinancing also varied by race, with Black homeowners with mortgages less likely to have refinanced at 13%. Okay, and then our final slide on family finances shows one of our most commonly cited series on handling unexpected expenses. It's what we call the $400 question. So when asked how they would cover a hypothetical expense of $400, 64% of all adults in November said they would have covered it exclusively using cash, savings, or a credit card, paid off at the next statement. Taken together, we refer to these payment methods as cash or its equivalent. The share who would pay with cash or its equivalent from November 2020 was largely unchanged from the fall of 2019. However, similar to what we saw with financial well-being, we did see fluctuations throughout 2020 when we look at our supplement data. So we actually saw a rise up to 70% in July, which may reflect the pandemic-related relief policies that had reached many households. Following July to November, we once again saw a decline, which is consistent with some families spending down additional savings from these relief programs over time. Okay, so before I move on to this financial literacy experiment, I just wanted to see if we had any questions.
Yep, we have a few questions. So the first, with regard to your splits by looking separately at people who are laid off and not laid off, how do you define unemployment? And are you concerned about households who work in the informal economy and who may not, who may answer that question differently?
Sure. So in the Shed, we try not to define like unemployment in the way that you would, using the BLS. The results for layoffs are based on a question that it asks people in the past 12 months, have you lost a job or been laid off? Something along those lines. I probably don't have the wording exactly right. And so that's a self-reported measure of whether or not they were laid off. We're not trying to say that they're currently unemployed, that we have separate questions to find out like their current work status. But the information we're reporting here is just if someone experienced a job loss in the past 12 months. They may be not working now, they may not be looking for work, they may be currently employed. So we're not making comments on unemployment. We have a separate set of questions on the quote unquote gig economy, which I didn't really have time to present here. So somebody who's not working like in a traditional job, it's up to them how they interpret the have you lost a job or been laid off. So sure, it's possible somebody was, driving for Uber and they have like a lot less customers. And so that affected their income. But that's probably something different than a layoff, unless the person views it that way, since this is a survey. I'm not sure if that quite answered the question, but that was our approach. So we can look at those gig questions to get more of an idea about what's going on in that sector, if you will. I just didn't have time to include it here today.
Got it. And then with regard to your results on withdrawals from retirement plans, by cash out, do you mean took a distribution or a total cash out of the plan?
It could be partial. So I think that's not, I would have to look back at the question. So the retirement section is not, is one that my colleague Ellen is the expert on. But I believe that question is like, it could be partial cash out. It doesn't mean you have to take the entire thing. I think it's part or all of.
And then to kind of on that topic, did the Shed include any questions that might help understand the unusually high reported number of early retirements during the pandemic?
Good question. I'm not sure. I would have to refer to Ellen on that if we had questions about why people retired. I know we have a series of questions where we have like factors that contribute to people retiring. And I'm not sure if any of those really popped to where we could say like, oh, hey, look, this is COVID. It might be the case. I'm just not remembering. So we can, if you want to, the person who asked that, if you want to shoot me an email, I can talk to Ellen and follow up on that.
And then do you know what, like how the retirement savings accounts are invested at all? Do you have any information on that?
No, I don't. Well, I shouldn't say no. I don't believe so.
Okay. For the question about being able to cover an expense of $400, what are the other options that the survey provides besides cash equivalents?
Let me can check that. Okay, here we go. So there's credit card that you pay off in full at the next statement, credit card that you can pay off over time, using money currently in your checking or savings account, using money from a bank loan or line of credit, borrowing from a friend or family member, using a payday loan, deposit advance, or overdraft, by selling something, or just I wouldn't be able to pay for the expense right now. That's the full list of options.
And were there any trends in these other options during this time period that you noticed?
That I don't know off the top of my head. So I just am familiar with the breaking off of the cash or its equivalent or the other. I don't recall. But again, that's something that we could check. So please feel free to shoot me an email and I can double check that.
Okay, thank you.
Okay, so now I'm going to change gears to talk about a simple experiment that we did with the financial literacy questions on the 2020 SHED. So one of the really nice features of the SHED is the flexibility that it affords us, not only to cover many topics, but also to dive a bit deeper into certain topics. And one area where we've tried to do that is around gender differences in financial literacy. So SHED has long included the big three questions on financial literacy, on risk diversification, inflation, and interest, which are shown here. So I'm going to assume that this audience is pretty familiar with these questions, so I won't belabor them here. So now looking at gender differences, previous research has shown that women are less likely than men to answer these financial literacy questions correctly, and that they are also more likely than men to select don't know. So the figure on the right here shows that we see these same patterns in SHED. So the dark blue bars show the share that answered correctly, the light blue show incorrect, and the yellow show the share that selected don't know. So for the example, on the diversification question, we see that 34% of women answered correctly versus 50% of men. We also see that about 60% of women selected don't know, compared with 46% of men. So looking at these high shares of don't know, it really makes you wonder what would happen to the gender gap if you took away the don't know as a response option. So would more women get the answer right? And are women just less confident than men? And that's why they're saying don't know, but they really have a similar knowledge. So if we look to the literature around why there's a gender gap in financial literacy, we find a really nice paper by Anna Maria Lusardi and co-authors. And it addresses this very question around the don't knows. So in this paper, they implement an experiment using a Dutch household survey. And here they had a panel of respondents where in the second wave, they took away the don't know response. And nicely, they also added a question about how confident the respondent was about their answer. And here they find that women are very likely to give correct responses, but they are also less confident. So they're able to provide evidence for this confidence story. And they conclude that the gap is driven both by lower knowledge and also by a lack of confidence. So bringing things back to SHED, so much in the same vein as the Anna Maria Lusardi and co-authors paper, in the 2020 SHED, we did a simple experiment around the don't knows. So of course, with SHED, one difference is that this is in the US context. And another difference is that we have sort of both of a cross-section and a panel component to it. So in the 2020 SHED, half of respondents received don't know as an answer choice, and the other half did not have don't know as an option. So below, here's an example just of how we implemented this for the diversification question. So there are two answer choices, and then half the people see a third choice, which is don't know, and then the other half only have those two available to choose from. And then, as I mentioned earlier, SHED also has a panel component so that we can follow people over time. So in 2019, everyone was given don't know as an option. So we're able to look at how people responded in 2019 when they're given a don't know, and then for the half where don't know was taken away, we can look at differences there. So we have cross-section and panel differences. So this is still very much a work in progress. My colleague, Anna Tranfalia, has really been spearheading this work, and she, along with my other colleague, Ellen Mary, and I are currently analyzing and writing up these results, so please stay tuned. We're hoping to have more results for this talk, but I'm just providing this teaser here. So some of the questions we're hoping to answer include how much of a knowledge gain do we see in the shed beyond what we would expect if people were just purely guessing once you take away this don't know? And is this gain greater for women? So generally, how much of this gender gap in financial literacy seen in the shed in particular can be explained by this difference in propensity to select don't know? And are there any implications for other behaviors or financial decisions we observe in the shed? So as you've just seen, we observe a lot in the shed, so it'll be interesting to see how that could tie into other things. And then finally, we're just hoping too that this experiment helps inform how we ask questions on the shed going forward as well, depending on what we find and what we decide we want to learn, whether we want to keep this half get don't know, half don't, or we think it's better to include don't know or remove it. So we're hoping to kind of answer that to help guide how we ask things on the shed. Okay, and then lastly, to wrap things up with the last few minutes I have here, I thought it might be nice to go over some of the new topics that we have in the 2021 survey. I know I'm really excited to see these results. In fact, Shed 2021 is now out of the field, and we just received the data this week. Sort of an early Christmas present that also comes along with a lot of work, but it's really exciting to dig in and see the results. So I very much have 2021 at the forefront of my mind this week. So here I have just a brief overview of topics that we've added. So on well-being, we now have an overall life satisfaction question in addition to our questions on perceptions around financial well-being. We also added questions around the receipt of the monthly child tax credits and also questions on how the credits were used. Oops. We added quite a bit on employment around COVID things. So COVID concerns and loss of UI were added to a list of reasons for not working. We added questions around people's telework preferences. For people who changed jobs, we wanted to know about their perceptions of job quality. So, we've heard stories about people leaving service industries. So we were kind of wanting to get some information around there. For housing, there's been a lot going on with public policies around rental assistance. So we were asking if people are behind on rent, how much they're behind, whether or not they've received rental assistance, why they have or haven't, or I guess why they haven't received assistance. Health-related things, we've asked about perceptions of employers' COVID precautions and vaccine requirements. One exciting piece too is we're now linking from our vendor's background survey disability status, so we'll be able to add that as a variable that we can cut the data by. Education, we expanded a little bit more around perceptions of COVID-19 precautions. So this kind of mirrors employment. Do parents think schools are taking enough precaution, not enough precaution? And the same thing for higher education. We also ask about disruptions to in-person education, perceptions of academic progress. Banking and credit, we have added questions on this sort of new product called Buy Now, Pay Later, which you may have seen as you've been online shopping. Companies like Affirm and Afterpay, they allow you to pay for a purchase over time, which have really been increasing in popularity. So we're interested to see those results. We also added a question on overdraft, which I do a lot of work on financial inclusion. So I'm happy to see that. And then we added a brief section where we brought back some old questions, added new questions around direct stock investing, cryptocurrency, gambling, and financial risk taking. And then we also added a question on climate change, several questions on climate change, where we ask if people have themselves experienced financial hardships from natural disasters or extreme weather. Also, we ask about their expectations about future risk from natural disaster, extreme weather, and whether they've done any changes like purchased insurance, made improvements to their home, thought about moving, things along those lines. So that's a brief, very brief overview of our new questions. I just want to remind everybody that the full report is on the website. We also have some interactive charts that was new for this year. And then just a real big thank you to everyone for tuning in today and for the organizers for inviting me here to speak.
Great, thank you, Alicia. So we have a few more questions coming in. So the first is, could you discuss a little bit more how you define, could you describe a little bit more how you define financial well-being? And specifically when people respond, how do you know that they're using the same criteria and to say that they're doing well financially? And if not, is there a concern that this kind of changes in what you observe are due to changes in the sample?
Sure. Okay. So let me try to unpack that. So sometimes when I'm speaking, I say financial well-being as a shorthand. Really, when we're analyzing the data, what we mean by that is this question where we ask people how they're managing financially. And it's like a 5-point scale, but we simplify it to doing at least okay or not doing at least okay. And so understandably, you might think, well, is that, a broad enough measure of financial financial well-being? And I do think it captures quite well financial well-being. So for the 2020 SHED, we also included the CFPB's financial well-being, the shorter question, which they used to create an index score. And we saw that the results from those 5 questions largely mirror what we found with just the how are you managing financially these days. So the results were almost parallel there. So as far as a subjective measure of well-being, I think that one question is capturing it fairly well. So you also might be concerned, okay, well, maybe you don't want a subjective measure of well-being. I think that could be somewhat of a academic argument in a sense. Like the CFPB strongly argues that subjective well-being actually is what you want to measure when you're looking at well-being. But maybe as a researcher, you're interested in something different. So if we look at the questions that we have around ability to pay bills, the $400 question, we also have questions around like emergency savings. So if you look at those more concrete measures, we also see similar patterns. So all of these different measures that you might think capture well-being, they tell a similar story if you're looking at trends from 2019 to 2020. So I think that kind of, if you look at everything as a whole, it is telling the same story. When I was first looking at these well-being questions, I was a little bit concerned like, oh, well, if it is subjective, maybe people think like, well, the world's going to, HELL, at least I'm doing okay. So maybe that measure wasn't quite capturing like declines in at least, and how people were doing. But the ability to pay bills, it matches, it kind of mirrors it. And the $400 question looks very similar. So I think that it is, I think it's capturing things well. And then we also have are you doing worse off? So, people do this sort of overall point in time thought about how they're doing, but we also ask them to do this comparison to a year ago. So I think, taking all these measures together, we can paint a pretty good picture of how people are doing financially. And, just loosely speaking, I say financial well-being, but I think all of those different aspects can encapsulate that.
Continuing on that, there is a very, very famous question here that people quote all the time, the $400 question, which I think is also misunderstood, often is misquoted or, they meant. So can you say a little bit more about this question and kind of clarify, how it is defined? And also, what do you think it captures and what do you think is the main message coming out from that $400 question?
Yeah, that is a really good point. I think if we could, I'm sort of new to the board. I joined about a year ago, so I can't speak for myself. But I think going back in time, maybe that question would have been worded a little bit differently. Perhaps that's an experiment we could do going forward. I think the way it's commonly interpreted is like, how could people pay for a $400 expense? Like, how would they be able to? But the question isn't asking that. It's just asking, what would you do?
Right.
So maybe somebody says, well, I would use my credit card and pay it off over time, just for whatever reason, that's what they choose, even though they had the savings to pay for it up front. So that's a really important distinction with that question that I often think gets lost in the media and when you hear reports of it. That said, it does match our other measures, fairly well. So we have questions asking about difficulty paying bills if you're faced with a hypothetical expense, whether or not you have savings to cover an emergency. So we do have these other measures that tend to follow that $400 question. So it gives us confidence that it's sort of, even though people are interpreting it wrong, it's still like, it follows those other measures. And I think if it wasn't so well known and cited and people look for it, it's possible we may, change it. But given that now we have this long trend, we're reluctant to go and change it. But it is a point very well taken. And I think it's good to clarify exactly what it is capturing versus what it isn't.
I'll leave it to Vitali maybe for one last question, and then I think we can close.
Sure. So I think that was it for questions from the audience. But one question that I had was that, the takeaway I think from the presentation is that there's a lot of heterogeneity in that some households, particularly those, there's a lot of heterogeneity by race and by the amount of education, but kind of on average, a lot of the measures of well-being are kind of back to 2019 levels. And this was taken in November 2020 after the first stimulus checks had been sent out, but before the second and third. And so kind of, obviously you don't have the results from the 2021 survey, but looking ahead, what do you expect? What might you find in terms of financial well-being?
Yeah, I suspect that it's either stayed the same or gone up. So if you looked at our supplements, you could see some movement. So it dipped in April, and then the first round of stimulus went out, and it went higher. By November, it had gone back down. So since then we have received more stimulus. The economy has been rebounding. We're still not where we want to be, but things look a lot better than they did early on in the pandemic. And we have, a lot of relief has gone out. It hasn't necessarily reached everybody in the case of the rental assistance and those things. But people are getting the child tax credits. I think all, of the sort of macro level indicators are looking good. So, I expect the overall measures to increase. I'll be interested to see what the gaps do. I think that's where I'm unsure. How are the people with less than high school doing? Are they doing better? Are they still looking like they're struggling? Or how are the racial and ethnic gaps looking? Are those, shrinking? Or are they still, looking big? What's going on with childcare? And, after we did the shed, there was a lot of news stories after the survey had been completed, about women of color and mothers of color experiencing negative employment outcomes, particularly due to childcare. And so that wouldn't have been picked up in the November shed. So I'm not sure if we'll catch that, a year later, but all very good questions. So I will be diving into that over the next month or so.
Well, thank you very much, Alicia, for this very rich presentation. I have to say, of course, the SCF is this impressive data set from the board, but the shed is so impressive. And also it's, the data is collected each year. And so, we have this, each year one can get this extremely rich information. I think the presentation that you have given today, I think, really raises many research questions that people can address with this data set. So we ourselves here at GFLEC, we have looked at some of this data. It's such an incredible, rich source of information. So, I am just so excited that the board that started this data collection. We have this important information, very timely. And of course, I cannot not mention that there are the financial literacy questions. And I'm just so glad that you're doing this experiment. So I very much look forward to continue the conversation with you and figuring out, what you did find when you took away the do not know, which is, another important things. But of course, beyond, of course, the financial literacy question, I echo what people have been saying. This financial well-being are very interesting, in a sense. How are people, are they able to get to the end of the month? Do they have precautionary savings? Are they constrained by debt? These are all important outcomes to look at, because at the end we want to know, what is the in a sense, how people are faring during the pandemic. And I think this data opens the door to so many important kind of research questions and opportunity to study this question a lot more. So I want to ask you again to tell us where we can access the data, so that many of the people who are still here, and we had a very large group of participants today, can find the information and can find, by the way, the presentation. I hope is we will post on our website so that you can get some of these preliminary statistics, and we look forward to reading more about the data. But Alicia, tell us again where the data is available.
Sure, thanks. Yes, so there is a link here on my last slide, and I believe in the invite they also sent out a link to the data. But if you just Google SHED Federal Reserve, it'll pull it up, and you can go to our site where it has all the years of the data and the reports and some visualizations. And please feel free to email me if you have any further questions or follow-up questions. I'll be happy to get back to you.
Thank you very much. This is great. And we have one more seminar. It's next week. So we look forward to seeing all of you next week again. Thank you again. Bye-bye.